Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome. My name is Bryce, and today we're diving into all things infrastructure and looking at some of the big themes that are playing out in infrastructure today with two experts from Magellan. To chat through it, as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm excited for this episode. Infrastructure is a topic that has really piqued my interest of late. For many people, it's probably quite a boring sector of the investment landscape, but it's been an incredibly lucrative sector of the investment landscape. A lot of wealth, especially for Australians, has been built in the infrastructure space, and Australians are kind of experts going around the world in investing in infrastructure. So it's something we punch above our weight on. You'll love to see that. And I'm really enjoying learning more about it.
Yeah. I always, coming into these interviews, I don't have any specific infrastructure exposure in my portfolio. Like, I don't have an infrastructure fund.
Yeah.
I obviously, through the indexes that we own.
Like the ASX 200 would have Transurban.
Exactly. But I don't have any infrastructure exposure. I'm looking forward to this interview because there's always plenty to get out of it. And it does make me consider what I should be doing with my portfolio.
The two big themes that we're going to drill down on today with our two experts, who we'll introduce in a sec, but the two themes are the decarbonisation and global energy transition. Massive theme, trillions of dollars worth of infrastructure needed to do it. And then the second is aviation and airports. Some of the absolute jewel in the crown infrastructure assets are airports. Still annoys me that Sydney Airport got taken off the ASX. Separate conversation.
Yes.
So some big themes in infrastructure that we're going to be talking about today. To do it, we're going to be joined by two experts today.
From Magellan, we've got Ben McVicar, who is a portfolio manager and sector head of infrastructure and industrials, and Jowell Amores. He's a senior investment analyst and portfolio manager, both responsible for the number of Magellan's infrastructure funds. If you want more information on that, we'll include a link in the show notes.
Now, before we get into it, we want to say a massive thank you to Magellan for sponsoring this episode and making it possible. With that said, let's get to it.
Let's crack on. Well, Ben, Joel, welcome to Equity Mates.
Thanks for having us. Thanks, Bryce.
So today we're here to discuss infrastructure and some of the big themes that are playing out in the world of infrastructure. But let's start with some definitions because, when I first started investing, and I'm sure a lot of new people in the Equity Mates audience, infrastructure meant bridges, toll roads. That was pretty much it. But of course, it's a much bigger world than that. So when it comes to investing at Magellan, how do you define infrastructure?
So when we think about infrastructure, really at a high level, it's not necessarily a bridge or a toll road that you're interested in. What you're really interested in is this idea that what you're going to invest in is an asset that is a monopoly, near monopoly asset. As you both know very well in investing, what you're trying to, you're really seeking to do is try to find assets that have strong competitive advantages, they don't face a lot of competition, and they can increase their prices steadily over time. Infrastructure ticks a lot of those boxes. So that's sort of the start in a nutshell. What we're actually looking for is these really high quality infrastructure businesses that give us pricing power, that give us because they're delivering essential services. So if you're an extreme example here, if you're in the business of providing running water to communities, it's pretty unlikely that because you have a recession, the users of that good are going to switch it off. And that's an extreme example. Run across the other side of the spectrum, you have things like TV services, mobile phone services. As we know from COVID, there is no way those things are getting switched off just because you have a hard economic environment. And so what we're really looking for is, for us, the way we view the world and filter the world is we're trying to say what assets out there deliver both essential services, which is really important for that demand characteristic of the assets. The second thing we're doing is we want to say what assets deliver reliable cash flows. And again, as you're probably both well familiar with, one of the key things that's ultimately going to drive share prices over time is what happens with the cash flow and earnings power of these businesses in the long term. So in the short term, share prices do what they're going to do. But in the long term, it's the cash flow generation and the reliability of that earnings power that drives the share prices. And that's really what we're trying to tether ourselves to. So in our world, we're invested in, if you want to think about what we do, it's sort of invested into three buckets. You've got things like utilities. So think electric power networks, think gas networks, water networks. We tend to exclude, and this is obviously relevant when you think about the Australian context, is we'll exclude companies like Origin or AGL. And the reason we do that is that's somewhat competitive. Ultimately, you're competing to sell power. You're competing to dispatch electricity. We want the ones more like in the North American marketplace, where there's no competition in that space. And then in the other part, you've already named a few of the other sleeve: infrastructure, toll roads, airports, those kinds of assets. And the last bucket is social infrastructure. You find this happens a little bit in the UK, where you get a private enterprise will provide the facilities for a school or a hospital, and it'll be effectively a contract with the government. That's actually a pretty small part of what we can do in our world. In the listed space, it's for us, most of the game is played in that utilities and sort of toll road or infrastructure sleeve, as we call it, of the world.
Yeah, right.
And there's an element to that, I think, that we like to attempt to differentiate ourselves from other infrastructure investors, and what we're looking for is additional confidence and certainty in terms of the cash flows. And so there are three particular risks that we look to avoid. So the first one, as Ben had alluded to, is competition. The other one is commodity risk. And again, to the example that Ben had mentioned around Origin, there is a certain level of volatility that comes from power prices, so to speak. So we'll look to avoid companies with material exposure to commodity prices. And the third one is sovereign risk. So there are just areas that we will typically be invested in OECD countries, countries where shareholder rights are protected by government and rule of law, more importantly.
So the next question I had for you guys was what makes infrastructure such an attractive asset class? But I think we've well and truly covered that. Monopolies on near monopolies, durable cash flows, pricing power. There's a lot of things to like there. So rather, I'm going to pivot a little bit. And for the infrastructure nerds out there, which I'm sure you guys count yourselves amongst them, what are some of your favorite infrastructure assets around the world? Maybe if you give us one each to really, I guess, illustrate some of those characteristics that you were talking about earlier.
I've got a few. I mean, I'm a bit more biased towards utilities, and that's maybe just my history. I spent quite a bit of time, half my life in the US, covering a lot of these utility names. I go back as far back, hate to date myself, but I go as far back as the Enron days.
Oh, wow.
In fact, my boss was in a couple of those books. But one of the names that I'll talk about a little bit more later in the podcast is WEC Energy. So WEC Energy is the utility, the dominant utility in Wisconsin. There are a couple of macro tailwinds that they're riding through. One of which is this massive amount of industrial activity that's happening in the state. The state government is obviously pushing for a lot of growth. And there's this particular corridor, the I-94, that stretches from Chicago. It's a straight line, straight highway, straight up to Milwaukee. And when you drive up this highway, this corridor, to both your left and right, historically it was farmland. They've all been turned into sort of massive industrial parks. So you're getting the likes of Amazon. You're getting Haribo, which is the German candy company. Not sure why they're there, but there's a lot of land. And then you've got other more traditional companies such as Milwaukee Tools, which is big here. A lot of that is manufactured there. Plenty of land. That's one that WEC is actually benefiting from, because they build the infrastructure to serve the power needs of these large companies, and they do it in a very regulated way. So regardless of how well those companies do, they are getting paid let's call it a 9.8% return on equity on the assets that they provide those services, and it's an incredibly, it's boring, but it delivers, and I think for the past, I believe it's for the past 16 or 17 years now, they've effectively exceeded the expectations in terms of what they earn. There is some incentives built in there, and they've been able to hit that for the past 16, 17 years. And on top of that, we're talking about as well, you've got the energy transition that I'm sure most of your listeners have heard about. This is a state that was historically very coal-driven, and what they've found is that they can replace a lot of that expensive coal. If you think about a coal plant, just the number of people that work in this coal plant, and then as well as the price of coal can sometimes move, which they do pass on to their customers. They're agnostic to the price. The cost of producing electricity from that coal plant is actually much higher than what it would be if you were to replace it with renewables. So they do have a lot of renewable sources, particularly wind. There is some solar as well. But there's this fantastic opportunity when it comes to energy transition for a company such as WEC in terms of benefiting from that.
Ben, what about you? Any infrastructure assets that really illustrate some of those characteristics?
Yeah, sure. Maybe one that comes to mind for me, Joel's just touched on some of the utilities side of it and why we like that part of it. On the infrastructure side, one that comes to my mind that we've held as a decent size position for us for a few years now is company Vinci in France. They're a very diversified business, so they've got a very large chunk of the autoroutes motorway intercity motorway network in France. It's a mature asset. It generates free cash flow like you wouldn't believe. It grows its tolls each year typically by a percentage of inflation, so it just ticks those up. And then it's France. You don't get enormous growth on the motorways, but what you get is just a steady uptick in terms of usage on that road. The other thing it's got is back in about, I think it was 2013, they bought, as a lot of the states in Europe were restructuring, they bought the Portuguese airport system, and that asset has just been an absolute screamer for them. They've bought this thing for the low billions, and effectively this thing's probably, most analysts would value this thing at just south of 10 billion these days. So it's been a hugely successful asset, and what you get is you just get that really strong leisure demand for, in a country like Portugal, it's a very leisure skewed economy, and you get that really strong throughput there. And in fact, they're having a major issue there at the moment where in Lisbon they're trying to work out how to expand capacity because their airport system is full, and obviously they want to get that moving again, and so they're having a discussion with the government how they can get a new airport built. But the problem is the government has fell over, so now they're working out who the hell they can talk to. So it's all happening.
Tricky.
That's Europe for you.
Now, to close out the point around why infrastructure is attractive, Joel, offline you said that it's an asset that allows you to build wealth without needing luck. So can you just elaborate on that?
Yeah, so maybe just to go back to the example of WEC. So they are spending this year, it's roughly $7 billion in capital investments. And if you think about that $7 billion that they put in there, that goes into your what we call rate base, your asset base. And if I were to simplify how utilities, particularly in the US, earn their money, it's really two buckets. So you've got your asset base, and that's multiplied by your allowed return. So in this case, your ROE, what the regulator gives you. So you've got this tremendous amount of asset base that's growing for WEC in this case, and it's probably not too different for other utilities throughout the US. It's growing at anywhere from 6 to 8% per year for the next, what we're projecting is at least for the next decade. So you've got this large growing asset base, and you multiply that by the allowed return that the regulator gives you, which is for WEC is 9.8%. And it just compounds. It compounds every year, and it's growing again. We found that regulated return has been very stable over the past 15 years. Again, even through the GFC, even through the pandemic, it would be very difficult to tell when those events actually happen if you were to look at the historical regulated returns for these guys. And so, while it's not giving you the 30% tech returns that you normally come across, it's one that year in, year out, they will reliably deliver you those kinds of returns, and they've been doing it for the past decade or so for most of these utilities, and the risk profile for many of them, again, a lot of them have sold off the sort of the commodity sensitive, the volatile, unregulated parts of their businesses, and you've got this simple regulated business that again churns out 9.8% returns, and then growing dividends by a similar amount, and then year in year out, the investor gets to benefit from that. And for us, that's sort of the quiet wealth building that we tend to favor, and we think that there's real value in the average investor having a portion of their portfolio.
Nothing wrong with 9.8% a year.
Yeah,
There's a lot right with 9.8%. So turning to the fund that you guys manage, how does it work? Because there's a lot of different ways to invest in infrastructure. You can invest directly in the assets. You can find assets that are listed and invest in their equity. You can invest in the debt associated with the assets, or you can buy funds of assets. Like there's plenty of ways to do it. How do you guys do it at Magellan?
We're very vanilla. We invest in global listed infrastructure. So what we do is you go around the world, around the various stock exchanges, and you can find, for us, probably about 130 companies that we think fit the bill in terms of investment grade infrastructure. And what we're doing is we're building a portfolio typically of about 30 holdings. And as you'd expect, we're doing due diligence on those, trying to work out where we can see the value opportunities. So, Joel's talked about the opportunity to earn sort of high single digit ROEs on the underlying companies. We're trying to find those that we can buy at a discount. The discounts you find in infrastructure, these are pretty well understood businesses. So generally you're not expecting to find things trading at 50 cents on the dollar. But generally we can find a bit of a discount across to build a portfolio with. One of the differences, I guess, when you think about if you're investing in general equities versus infrastructure, is that due diligence valuation phase can be pretty detailed. So you might have a multi-toll road asset of which you're doing an individual DCF or discounted cash flow valuation for each of these businesses. So it can be pretty detailed, but the sector kind of is good for that kind of work.
I imagine more detailed, but far more accurate than some other DCFs you see. It's a lot more predictable. The assumptions aren't as wild. Whereas if you were to try and do like a DCF on Spotify now, for example, like the predictions you'd have to make about, what their margin profile looks like and what their users look like and where they go as a business could be wildly divergent, whereas a toll road is a toll road.
I think that's exactly right. In our space, it's the predictability of the businesses that really helps you. So you can go back and go, okay, I think traffic historically has grown at 2% per annum on this road. You can look at population growth rates, and really you're making assumptions. Is it going to be 2 or 2.5 or 3? And you're flexing that, but you're doing this over some of these concessions might run. We've got one in the portfolio that runs to 2086. So you do get a telescoping effect where you start to get something, you make an assumption, you compound that out. Most people understand that compound interest makes a big difference out in 2086. So you do have to think about that, but it's a bit more detailed the way you're focusing on it. And often you're just dealing with quite complex holding structures that you've got to look through. They own 30% of this asset and 40% of this asset. So it is a different game, but I agree. I think discounted cash flow type valuation can be a very dangerous tool. And I think, but where you have very underlying predictable businesses, it's much more in tune with that kind of approach. Yeah.
So we want to drill down on a couple of, I guess, the big opportunities or big themes in infrastructure today, get a bit more specific on some companies that are interesting in those themes. So let's start general. In the world of infrastructure, what are some of the big themes? What's capturing your attention at the moment?
One of the big ones, and this comes up a bit in our space, we've got a large portion of utility holdings in the portfolio. And one of the ones that comes up a lot, particularly in the electric space, is this decarbonisation and energy transition trend. That matters in our world. The other one that's been, and I'll just give you the sort of headlines for a couple, and we can dive in as you want. A couple of the other ones that come up for us is obviously we're seeing aviation round to zero in terms of volumes a few years ago during COVID, and that's been recovering really swiftly. For us is, and you've got to be a bit of a utility nerd to follow this stuff, but historically what you had was power demand was shrinking across most major economies. So you had effectively the per user power demand was going down. Why? Because of energy efficiency. what you find in these days is there's this big swing. All of a sudden you have these, and everyone hears about AI data centers, and that has quite a large energy use component. And you're all of a sudden seeing the dynamic shift. All of a sudden there's a really big growth factor back in power markets. And that changes when you think about capital plans, that changes the game a bit.
Yeah.
That's all the Bitcoin mining Ren's doing in his back garden.
All-time highs. Well, let's start with the energy transition, because I think, that's front of mind. And, for a lot of people, they're probably hearing about things like the Green New Deal and the trillions of energy investments that are going on with that across America and Europe. So what do we need to know about the theme as investors?
I'll start at a high level and we can drill down.
Yeah.
If you think about infrastructure and you think about where we sort of intersect with that world of decarbonisation is when you look at some estimates, about a quarter of global emissions are estimated to come from the heating and power sector. So you imagine what we're doing. We're investing in a bunch of utility companies as well as infrastructure, but these utility companies tend to own the legacy coal-fired and gas-fired power stations. So then the question you've got to ask is how much risk do these companies face? And we have this conversation as well, because what you'll see is not just us, but the infrastructure sector more broadly. When you look at the carbon intensity of an infrastructure portfolio, compared to the broader, say, MSCI global equities type benchmark, we might be 5 times higher in terms of carbon intensity. So the question is, does that create risk as you hold these assets as they start to decarbonize and you move away from those assets? What's kind of interesting is the companies that emit the most today in our portfolio, the ones that we actually see are probably, I know I've add one more point in this actually, this, I think is relevant here, is when you think about the need to decarbonize, I think this is a really important point that gets lost in this conversation, is that the game plan is not to switch off electricity use per household. The game plan is actually to move to electric cars, to move to electric heating in the right different climates. So all of a sudden you go, of that 25% of global emissions, you're actually going to have a hell of a lot more electric use coming forward beyond sort of the data center stuff we talked about before. So you actually have to do a hell of a lot of decarbonising within that sector. And so what we find is a lot of the companies in our space, they're working with their local regulators to early retire coal-fired power stations. They're replacing them with renewables. Renewables are deep in the money these days. If you went back 20 years ago, and I remember when I was working on the sell side, researching some of the stuff in Australia, solar was so far out of the money. Wind was barely in the money. It only got there with subsidy. These days, when you look at really highly productive regions, renewable power is often the or one of the most price competitive sources of generation now. So it's deeply in the money. And so because of this, I'll go back to what I was going to say before, which is that when you think about a lot of these utilities that have a legacy coal-fired power station, what they do is they go to their regulator and say, we want to retire this sooner rather than later. And what they do is they go, okay, well, we want to build these renewables. They can come up with a deal where they can get their money back on the coal-fired power station through customer rates, build a renewable power station, and all of a sudden you can actually get a really nice equation where you reduce carbon, you can grow your business because they earn money for investing. It's the kind of business they are. So you can create quite a nice situation for these businesses. We have plenty of examples of those, particularly in North America at the moment.
Well, do you want to perhaps talk through some of the investments that you're making in this space? You mentioned wind, solar, but are there any other areas in the energy transition or, perhaps examples of what you're excited about?
Yeah, great question, Bryce. I mean, when we're talking about, as Ben mentioned, there's a significant amount of runway for renewable investments, renewable generation sources. But we have to remember that on most occasions, these are wind farms, solar farms that are located in remote areas where wind availability will be high, but it's further away from the demand source. And so the connecting factor naturally is are transmission lines and as well as the distribution lines as well. And we've come across findings, and there's a few studies out there where in order to reach the renewable capacity as a country, we're talking about the US in this case, to get to reach some of the net zero goals targets by 2050, there's a certain amount that needs to be spent on obviously the generation. But when we're talking about just the transmission and the distribution component, there are studies that are predicting anywhere from $2.5 to as much as $5 trillion that needs to be spent in that asset through 2050 in order to, again, reach that net zero targets. Now, even if it doesn't hit that, it's still a lot of opportunity for these utility companies that are, again, putting that into their rate base and then earning the 8, 9, 10% return that the regulator allows them. That's a tremendous amount of money and wealth being generated for, in this case, for the shareholder.
The question is, will that amount of money be spent?
That's a really it's an interesting question. I mean, it has to be spent to hit what everyone's talking about.
Yeah, but
the challenge is the industry, as far as a run rate cadence, it takes time to ramp up your ability to deploy CapEx. And I think the hardest bit about this as well is you have to step back from the whole thing as well and say somebody has to pay for it.
Yeah.
And ultimately, the way that's structured in today's economy through these utilities is the consumer pays for it. So either governments are going to have to step in and provide some subsidy if they want to really just press the accelerator, or people are just going to have to accept that their electric rates are probably going to have to increase a little bit higher in the long term, which might make sense because your electric rates are probably compensating you if you're in a cold climate for the fact that your heating bill's going down because you're not using as much gas as an example, or maybe you're using less petrol for your car. But I think mentally it's going to be quite hard for people to accept that your electric bill is starting to absorb a lot more of your overall pie of your utilities bills.
The cost of not spending it will be a lot higher as well.
Exactly, and really it comes down to the regulator, and ultimately it's the governors of each of the individual states that taps that regulator on the shoulder and says, hey, we need to hit these emission targets. How do we do it? We do it through incentivizing the utilities and ultimately the shareholders by providing a fair and reasonable rate of return. So again, the ROE, the 9.8 might sound high, but again, one aspect that we have to think about, particularly in the US, is that the way to look at it is there are 50 states competing against each other, trying to compete for that incremental dollar of investment. And how do they do that? They provide an attractive rate of return, and so that's how they get it. Will they get there? That's obviously it's
whole nother conversation.
That's a $5 trillion that's a $5 trillion question. But even if you don't get there, I mean, that's still a lot of upside for many of these utilities.
Yeah, well, I guess making it harder to get there, or at least adding to the cost of the bill, is the uptick in energy usage that you mentioned earlier. So let's turn to that. Electric vehicles, everything else, but you mentioned specifically data centers is a big driver of increased electricity usage. So tell us the story there. And I guess, do data centers count as an infrastructure asset in the Magellan universe?
I'm happy to jump into the first one. I might swing to Joel for the next one, who's seen a lot of this stuff with his research at the moment. Data centers are interesting because obviously there's a demand profile that just has grown like a weed at the moment. And the interesting part for us is, as we said right at the outset, what we're really looking for is, can we be really confident that the business we're invested in, the asset we're invested in, is going to be effectively a bottom drawer type holding, where you just buy it, you can sit on it for 10 years, and then you pull it out of the bottom drawer and it's still doing exactly what it should be doing. The problem we've got with data centers is there's a hell of a lot of demand. It's the competitive dynamics that we're less confident on. While an industry is growing really rapidly, I think it's really easy to get confident that there's really strong competitive advantages, but sometimes that hides the fact that if demand were to slow, that game can change. We just don't have visibility on that. And by the way, I'm not saying that will happen. I'm just stating the risk that we're worried about. And there are some data centers out there that probably make sense, due to physical location, or if you're one of the data centers that are located outside of, or one of the many outside of Silicon Valley, where you've got really strong interconnection links between various parts of the network, there's probably a really strong incumbent position. The problem you've got, though, is these assets don't come like a single asset listed on the exchange. They come in a giant portfolio, and trying to work out which ones you think have the advantage versus are more competitive. That's the hard bit for us. So we've done the work. We don't tend to move too quickly when we're trying to get confident on these things, but for now we've just we're watching them on the sidelines.
And I think that's the beauty as well. We're not trying to predict who will be the winner in that's not our game. I think you guys are better at doing that. What we're interested in, again, is benefiting from this tailwind of growth in data centers, and how do we make money doing it confidently and with as little risk as possible. And for us, infrastructure is a particular way of going about that. So I'm sure that both of you know more than we do. We're not tech experts here, but there's really two types of data centers. One is more the cloud-based sort of data center, cloud-based computing. That tends to require much more speed. So you'll tend to find that sort of closer towards the demand centers. Northern Virginia is probably the capital of data centers. But then you have the generative AI data centers, and their latency is not, it is important, but it's probably not as important as it is for cloud-based computing. And so what you're finding is with generative AI data centers, they're probably located in areas where you can build large, you've got more land availability, cheaper land, and you can build it relatively easily. And so what you're finding is somewhere outside of the main demand centers. And for us, the way I think about it, the exciting part is I think about the growth. So, at this point in time, about half of the projected demand growth for power is actually what they're saying is will be dedicated towards data centers. So they suck up a lot of energy, and it probably feeds your crypto mining farm. But they require a tremendous amount of power. Actually, half that power is really goes towards addressing the cooling needs of the power. So it's interesting. I was actually talking to WEC over the weekend. We were talking about some of these things here, and they're looking at ways. They're actually advantaged because particularly in the winter where it gets really cold up there, it's easy to cool a large data center. But when you have during your warmer months, it's you spend a lot more energy in terms of cooling the place, and some of the things that they're thinking about. Again, they're in an area where it used to historically be farmlands, and they're looking to revive that. And so one of the ways that they're looking to revive that was taking some of a lot of the heat, most of the heat, out of these data centers and then filtering it through potential greenhouses. In terms of growing that. So it's a use there, but I think the point here is that they take up a tremendous amount of power. So WEC has this tremendous. They signed an agreement with Microsoft. So Microsoft's gone in and bought land from Foxconn. So Foxconn had this. They bought they were looking to set up a manufacturing site, which they never went ahead with. And so Microsoft's come in and said, we'll take that land. They've got about 1,000 acres. And then they recently signed for another 300 acres. And most of it will be the building itself. So you won't see too many green space there. This is a very good example. That one facility will actually require WEC to increase the amount of generation it currently has by 15%. So they've got about 7,000 gigawatts of generation at the moment. This one facility is going to require them to source an additional 1.4 gigawatts just for that one facility.
Yeah, wow.
So you can think about all the effects there, and again, it's not so much they're agnostic to whether it's Microsoft or Google or any other hyperscaler. They're more concerned about providing the infrastructure, the substations, and the spending that's associated with building the transmission, and then ultimately the generation, the power generation, and getting that there. And so if we think about that. The opportunity for them from an earnings point of view, again, that goes into their asset base, their rate base, and then you multiply that by the allowed return. that's a tremendous amount of wealth building for an investor into WEC.
That's huge.
Now, one final question on the energy transition, and then we want to move to the aviation theme, but we can't talk about the energy transition without asking about the topic that seems to be capturing a lot of retail investor attention and also politician attention recently, and that is nuclear energy. Any investments in that space or any views on how it fits with this broader theme?
Yeah, you find in the US, obviously there's a larger build there's a larger nuclear fleet that exists. So it does sort of pop up in the utility space. It's an interesting topic because, as you've exactly pointed out, energy, for better or worse, tends to get pretty politicized, both in the government sense as well as in how people's views tend to form around it. Renewables versus fossil fuels versus nuclear, no nuclear. Nuclear at a fundamental level seems like it has pretty good statistics to support it, right? In terms of the carbon output, the base load capacity of the power source. The problem we have as investors in that space is it can be a very expensive way to invest capital. What we've seen is, and in fact, there was an article I sent around the other day, which was basically pointing out that there was a study done a few years ago. I'd missed it, but it was done a few years ago. And it basically said they looked at a whole bunch of nuclear builds historically, so 180 of them. So 180 reviewed. 175 of those 180 had a cost overrun. The average cost overrun versus the initial cost estimate was 115% of cost. Wow. Double, more than double. Yeah. Which we can give you anecdotes of how that's played out in practice. And in addition, the average build has taken 65%, thereabout, if I remember correctly, 65% longer than originally expected. So you think about, you're in the game of investing capital. We're not talking about cheap projects. These are often multi-billion, often run into the tens of billions development. And we've seen some, in the US, we've seen some developments there. It's been pretty ugly. So from our perspective as investors in this space, it's definitely interesting, and I can see the environmental baseload decarb angle of it. The problem is, as investors, it's really hard to get excited when you look at, we were sort of joking the other day saying if a company announced that they were going to build a new nuclear power station, we'd probably be running for the hills right now.
Yeah, we've actually, there is one utility, and they're in the midst of, they're at the tail end of finishing up their nuclear plant, and it's the first one that's been built in almost 30 years, and I think that probably says a lot in terms of the appetite for building these things and trying to get some sort of a return. And the company Southern, which is the dominant utility down in the southeast of the US, they've just built. They've been working on this nuclear plant, Vogtle, and this. I suspect that this one particular project probably skewed a lot of the stats that Ben had just given you. So this is just to run off a couple of stats. So this is a facility, a plant that was designed to generate 2.2 gigawatts. So it's probably tiny compared to the data center example I mentioned to you, but that was designed to cost $14 billion. Right, which is a big number in itself. Today, that's blown out to it's over $35 billion. So it's more than twice the budgeted costs. They were expecting to build that in 7 years. It is now 14 years. Now, mind you, there were some disruptions with COVID, and but even without that, you'd say cost them set them back by maybe a year, 2 years. It's just difficult, and it's expensive. They had to redesign that plant 20 times. So that's why when you go and build a house and they tell you never change the
your
design.
Renovation costs.
It's the same. It is the same principle. We've talked about you'll hear about the small modular reactors, so the smaller ones, and the genesis of that is to address a lot of those issues that Southern had with Vogtle. But again, it's sort of many shareholders are, and even utilities themselves are very apprehensive about anything with the word nuclear.
Yeah, okay.
It's you will shorten any conversation with Southern if you talk nuclear with them.
Well, let's move to the aviation theme. And over the last the decade leading up to COVID, there was no doubt that airports were a great infrastructure asset. Talk us through what's been the story in that space since COVID.
Yeah, absolutely. Airports have always had this. Effectively, what you've had is aviation as a sector has typically grown at a multiple of global GDP. So I'm sort of taking you back to the long history, and the reason these are such nice assets is you get a monopoly asset in a given catchment area. So, that's a great tick. Then what you have is effectively globally you get this GDP plus type growth profile. And what's been driving that is you've had the world's getting richer on average. And as people get wealthier on average, they tend to switch to air travel and they want to do international travel. And that's been a big uptick. So you've seen that sort of tourism, you've seen business to business travel, and all of that's driven that story over time. And in addition to that, historically, I know this doesn't feel like in the last few years, but historically, ticket prices in real terms have just declined every year, right? So to the point where going overseas is not such an enormous stretch for most of the population in a wealthy country. And then obviously COVID hit, and it really, it was an order of magnitude worse than most downturns we've seen in aviation. Now, we've always known, it's not new to us, that aviation, out of all of our sectors, will occasionally get a decline in traffic. So if you think, 9/11's a good example of that, had the SARS scare, and then obviously COVID hit, and that wasn't just a slowdown, that was almost a standstill of global aviation for a long period of time. What's happened since is we've seen a pretty swift recovery. I think most people appreciate that there's been that kind of revenge travel thematic playing out where people are just getting on planes ASAP. And what we've seen is there's been a capacity shortage in global planes, and that's effectively meant that ticket prices have been really high. And what's happened though is, I remember very clearly when we were sitting at home for the first time during COVID in 2020, our airports are in standstill. We're trying to work out, effectively doing balance sheet reviews to make sure how much capital they have, just to make sure they can see out this indeterminate length of the storm. And then looking at it and having a debate about when do you think aviation gets back to the 2019 high water mark in terms of total global traffic. The debate was probably centered around 2025, 2026. As we're sitting here in early 2024, global aviation is kind of back globally. It varies region to region. If you were to look at North America, you're above 100% of that old high water mark, so you're at a high new peak. But if you look at Asia, you're still down, particularly in China. China's domestic's doing really well, but international travel out of China is not so crash. Japan was a late opener, so that's taken longer to ramp up. But it's kind of back there. And what's interesting, the way we've played this game in aviation on this recovery is that we long held a view that the parts of this sector that would come back fastest would be effectively the leisure travel, so personal travel or visiting friends and family. The other part that would come back is shorter travel. So obviously, as you think about it, it's almost like a ripple effect going out. Toll roads are going to recover really quickly. And then as COVID receded, you're going to see short-haul travel recover really quickly. Then long-haul travel will recover the slowest. And then business travel is obviously the one that everyone's used to doing Zoom calls and all that kind of stuff now. And so that's going to take probably more a structural impairment. But we long held the view that the best part of the market to be in was probably that leisure, airports that are over-indexed to leisure, and airports that are over-indexed to short-haul travel. So I'll give you an example just to bring this to life a little bit, keep it out of the theoretical. We've got one of our largest airports holdings is a company, Aena. They own, their key position is in the Spanish airport system. So Madrid Airport, Barcelona, two key airports in their operation. The nice thing for them is they index to a couple of things that are really attractive given that framework. One, they are about 90% domestic Spanish travel, or sort of call it European UK travel. So, relatively short-haul travel. They index strongly to leisure compared to other airports. And then the other factor here that's really nice, when you think about the recovery, is that compared to a lot of airports, they over-index really strongly to low-cost carriers. So cheap travel is really key here. So you've got all these different factors here that have meant that that's recovered really quickly. So I said before, aviation's back as we sit here in early 2024 in terms of global statistics. But airports like ones in Spain or Portugal, which I talked about earlier, they're at kind of 110, 115% of the old high water mark. So they're already up 10, 15% on where they were. So it's kind of that thematic's played out really nicely. So aviation's come back much faster than expected. The world's still struggling with capacity because no airline expected this to come back as quickly as it has. Everyone's been scrambling to add jets back into the equation. But aviation tends to get there eventually. So I think there's still a bit of growth still to come in this space.
Love it. Well, guys, to wrap up, you've certainly made the case as to why infrastructure is, in your eyes, a sexy asset. Can you perhaps just close out by, for everyone sitting there thinking how they should now start putting it in their portfolio or making it a part of their portfolio, what are some of your pieces of advice about bringing it into the portfolio of our audience?
We see all kinds of things, don't we, in terms of how people use infrastructure in portfolios. Generally, infrastructure is going to give you a far more defensive characteristic and is going to have a diversification benefit in a portfolio. So what we typically see is either people have a dedicated infrastructure sleeve in their portfolio, and we see this often in the institutional space as well, as it might be a dedicated infrastructure sleeve. But otherwise, people use it as a lower vol, more defensive part of their equity sleeve as well. So it does vary a little bit. I don't know if you had any additional thoughts on that one?
No, not too much. I mean, again, they see it differently in terms of their own objectives. The one that I hear quite often is it's a bond with growth, adding that to their portfolio. But no, it's primarily it's a defensive. Probably not too much to add.
No, that's fine. That's fine. I appreciate it. Well, Ben, Joel, thank you so much for joining us. It's been an absolute pleasure. We appreciate it.
Thanks for having
guys.
us.
Appreciate it.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.